Hi everyone. Today is Thursday, January the 27th, and 2022. I got the year right this time. um, and it's a little bit later in the day for me making this video because usually I charge my car when I drop off my kids and not before I pick them up. But so it's nice and sunny. Anyways, today I'm not reviewing a book. Today I actually, a few questions came up, specifically one, two, three, four. Four questions came up. Well, one might be a part two, kind of five question. One is a two-part question. So these questions came up to me from a friend of mine. And, I responded over text. And this friend of mine said, you know what, you should make a video about this. I was like, why? Who would want to, like, these are, I thought people would know this. Or I guess I was guilty of what you call, or what Jim Rickards calls mirror imaging, thinking that other people think like you do. Definitely something I am guilty of. Yeah. Okay. So I'll just lay out all the questions first and then I'll go question by question. So one is, why do I keep saying that peak inflation has happened? Am I out of touch? Well, that's not what my friend said. Are you out of touch? Am I out of touch with like the prices at various places, etc.? Don't I have to fill gas in my car? Well, duh, no. But I'm not out of touch. I am aware of what the energy prices are, and which is why, you know, perhaps oil stocks are good to be in right now. But wait, just wait, because wait at least till you listen to what I have to say in this video. And if you do watch the market, just look at how one ticker called CL1 exclamation point and another one, I think it's XTN or something. It's a transportation index, iShares transportation. I don't buy the iShares stuff. I just look at that indicator, because if on the month it shows like it's going down, those are like early warning signs of what's happening to the economy. And also that CL1 exclamation point, that's the crude oil price. So it's at a resistance level right now. So only if it clears that, then you can go ahead and buy oil stocks. But right now, it's like everything is very iffy, and I'm going to, I'll obviously say more about that, because I'm, my friend was, well, like, is it a buy the dip or is it a wait? What's this? And why are you kind of leaning pro deflation or depression right now? And why do I keep saying we're on the precipice of a deflationary, like Great Depression type of event, depending on, whether the Feds actually go through with the so-called rate hike? How can that kick off a depression? Well, and if you say, because I do hold that gold goes up in a depression and in an inflation, but silver goes up only in an inflation. And this was the second question, like, wait, why wouldn't silver go up too? The third was sort of what my caveats are to both of these case scenarios. And then a little bit of sort of psychology of like, well, if this is deliberate, if the Federal Reserve, say, wants to crash the market, quote unquote, what are they really going for, and why would anyone do this? Are they just evil? And, whether they're evil or not, that aside, some of you may say, yes, they are evil. But actually, no, I like to think of things very objectively without labeling people, etc. So Though, I mean, gee, I call people sociopathic and whatever. But in any case, most people, they don't think that they were doing something wrong. They think that they were either like, meeting their, like what their targets, whatever they are supposed to do. And sometimes they think they're doing it for the quote unquote greater good. So not that I'm giving, I'm excusing anybody's behavior, but I will go through all of this since I kind of assumed that, that this would be obvious. But clearly it's not. So, why do I think that we're on the precipice of a deflation? So, inflation is an increase in money supply. Okay, yes, I know that's the Austrian definition. I know that is not a definition by, say, a definition by which someone like, say, Jim Rickards would go by, because he doesn't think that. He thinks it's also a function of velocity. And yes, that's true also, but I don't like to call that inflation. I like to call it rising prices. Okay, so when I say rising prices, I'll call those two things different: inflation and rising prices. Okay, so inflation already happened. The money printing, or not printing, whatever, the proliferation of currency already occurred in 2020. Over and above that, and this is where this kind of leads to that far longer term, say, devaluation of the dollar kind of currency situation that that I'm more systemically concerned about. That SDR proliferation of 850 billion, and that happened in August 2021, and another smaller amount happened in March 2021. But regardless, that's a huge level of base money. Okay, and when I say base money, what do I mean? Base money is like let's see. So suppose I have suppose you have stuff. Okay, you have, say, what do you have? Let's say you have some valuable item. I don't know what to call it. Okay, maybe, okay, you have a gold coin, and you say, based on this, I want to, like, keep this and raise. Based on this, I want to raise 10x of this as kind of capital that I'm going to use. So that's your, like, M1, say, money level 1. And then those other units that you created. So say you're not a person, you're like a government, and like you have certain assets and reserves, or certain oil reserves, or whatever reserves you have, right? That's your M1, that's your first layer. Then based on that, you have paper. Then you take that and you deposit it into the bank. Then once you deposit that into a bank, then that becomes a deposit, which is a liability of the bank because they owe it back to you. But based on that, they can now generate more money. Like, the same thing, like I said, gee, on this one, I raised 10 of that. So banks will again go ahead and raise 10 more of that. So now that's another, M2. And then if you qualify for a certain level of credit, that's another layer of, like, so it's like layers, M2, M3, whatever. So all these layers of money, right? Now the SDR, which is, it was originally created in the late 1960s, I think 68 or 69, and it was actually created to be a sort of a solution, or a kind of a solution maybe, by the IMF, and actually the convening powers, so to speak, the big boys, even though there's more big girls these days in all those groups. Anyways, I'll refrain from that. Um, but these guys created um, this SDR, which was like a M0, like a sub layer based on the voting rights of each of those sort of group of countries. And in another video, I think, I forget what I called it. I think it was a video I made for a 9 or 10-year-old in responding to that child's question. I described the SDR as sort of like a made up a made up sunrise time based on like whenever this, based on whatever time the whole group of people wake up. So it's kind of flawed and whatever. No, actually, that's more the euro dollar. Initially, though, the SDR was good because it was based on a gram of gold, or like a sub gram of gold. So it had a value. It had an anchoring. Anyways, I'm going way into the weeds on this. So um, so when you have all these layers upon layers and layers, at some level, oh crap, I went way off tangent. I was telling you why inflation happened. I guess you already know why inflation happened. And I don't know how to edit this video, so whatever, it's going to remain. So anyways, the point of it is inflation already happened in the asset prices. Those are now, or they have circulated into the economy. But the problem is that, or not the problem, it's not a problem per se, but all the stimmies are done. The Build Back Better scheme did not get, approved and whatever. And then the what was it, child tax credit or something that the government was supposed to give people, I don't know, whatever amount they were sending. I think, did that stop, or was that going to stop sometime in January? Okay, so all those things have stopped. At the same time, wages have supposedly increased. Now, all those things indicate that all of this, like the excess money proliferation that occurred, has already gone into the system. Now, supply chain issues notwithstanding, ultimately, you only have a certain amount to spend every month. So, if the prices of, say, super essential things, of fuel, of gas, etc., goes up, you're out. You have nothing more to like do discretionary stuff, restaurants, whatever. You just don't have the money for that. Now, that's where the velocity part comes in, that Rickards talks about, because rising prices, that does need a high velocity, right? Because and how do you create high velocity? You create a high velocity two ways. One, yes, it's either inflation, that's because like things are just kind of growing and abundant and all that, and people are just spending, and there's that kind of euphoria in the market. But the other way is through fear. If you're afraid that tomorrow the prices will be much higher than they are today, it's a psychological phenomenon. You yourself will go and like try to get rid of dollars as soon as possible. Okay, so that is now those two like kind of psychological factors that impact velocity, that impacts what people think of as inflation, which is really rising prices. Yes, that can happen, but to an extent. Here's why. When an economy is starting to, say, tighten, and I know Jerome Powell said that the unemployment numbers and all that are very good and this and that. However, and I highly recommend you go and watch this video called Who is Blowtorching U.S. Jobs? and it's by a channel called what's his name? John Titus of Best Evidence. The channel name is Best Evidence. Watch that. It's a very short, like hardly 7 or 8 minute long video, and very entertaining. Not just someone talking like this. It's very entertaining actually, and you'll see exactly why this labor force participation is so important, because the thing is, when you have a situation where, say, people are living on fixed income, they're not going to go off and just spend beyond a certain point. And especially when you're in a situation of like this monetary tightening, and I say tightening like, in quotes, because yes, I get it. It doesn't feel like a true tightening to any Austrian economist, because it's like, really? They're still buying bonds. Like, even if they're buying like a few bonds, they're still, pouring money into the economy. Yes, but think about it psychologically. And this is where, psychology is so important in thinking about money. You're not just going into people don't just think, oh yeah, interest rates are rising. No, the way people think is, or let's think like a trader or a bank, or like, people who take large loans, people who do trades on leverage. Okay, everybody who is on any kind of a variable rate type of a system, suddenly they realize, oh crap, like, so from 5%, now I have to pay 5.5% on millions or billions. That's what really, it prompts that sort of beginning of the sell-off. Okay, and as things keep selling off, and then as stock prices come down, or even that wealth effect of you open your like brokerage account, your trading account, and you see your number like 100K less than the previous day, you go, whoa, like even though they were all digits on the screen anyways, it has a psychological effect. And that is the effect. And just think, upscale that to like a company, right? A company has to like be profitable and have everything all greens, right, all over the place. So how is a company going to think about this? The company is going to want to then lay off people. And yeah, I know that sounds really absurd, given that there are so many quote unquote job openings. But let me tell you something, that only goes so far. Once you get to a point where you have to pay out that much in a salary, and and your like margins and your stock price and your EPS, everything is down, automatically, as an entrepreneur, as a CEO even, or as a CFO, you're going to suggest, let's automate. What can we automate? Can we get can we get people to like do their order, say, on a drive-through on a screen? Can we get those little robot trolleys to deliver food to different tables and have people order at their table on a little screen? Because this is just not cutting it. That is what's going to happen. Now, what happens when that happens? People start getting laid off. When people start losing their jobs, you see your friends losing jobs automatically, then you begin to also save, and that velocity of money decreases even further. And this is why, I mean, if any of you are looking at the charts right now, yeah, everything is falling, the dollar is rising. Why is the dollar rising? It's not like, it's not like the fiat currency of the dollar is has some inherent strength. It's a matter of people trying to hold back in that sense, or even say people who know, oh, now suddenly I have to say pay back this loan I took because the rate will go up. We're talking like say a variable rate type of thing. You'll say, you know what? Yeah, let me sell off these positions that had good gains and pay that, right? And while that thing is in clearing and in process, those are dollars. So suddenly you know there's a need for dollars, quote unquote, and you've sold, you've converted to dollars. Yeah. So as this keeps happening, as those margin calls keep happening, and people have this need for liquidity, this is what happens. Okay. So why do I say we're on the precipice of a deflation? I don't know if my answer was clear, um, but that's why. Because as this carries on, this kind of like, you know, wanting to keep what you have, one thing I did not explain properly was to the need to want to pay off debts if the interest rate is going to go up. Why do I say that actually kills off dollars or kills off money and is deflationary? The reason it kills off dollars is because these days, no, not just these days, since what, 1971, the U.S. dollar is actually, it says up there, Federal Reserve note. And what is a note? A note is not a love note. A note is a debt note. It's a bond. It's an obligation. I encourage any of you, you know, take out a piece of cash that you have and read what says there. What it says. It says this can be, this basically is an obligation that can be called upon in the use of all debts, public and private. Yes. That means that the Federal Reserve can basically call back those cash notes anytime in order to pay all debts, public and private. You see? So, yeah, your money is not your money. Like sort of like Khalil Gibran said, you know, your children are not your children. They are what? They're beings that emerge something from the depths of life. So I forget the poem. Anyways, yeah, it's like that. Okay, so where does gold come into this? Now, gold is the only asset class that, oh yeah, and this is where, okay, so as you have this deleveraging, right? You have, you may have a situation of defaults. So some people will sell positions to, you know, meet their debts, but other people who have nothing to sell and who, you know, they'll have to default basically. And as you have more and more and more defaults, you also get into the situation where now other people who were counting on, I was going to say who were banking on, no pun intended, but yeah, if a person A was counting on person B to meet their obligation, but then now person B didn't get their money from person C because C defaulted. As you have a situation of defaults, the systemic risk in the, you know, in the system, that's why it's called systemic risk, because it's the whole damn house of cards, right? As that kind of gets shaky, you're in a situation where you want to kind of avoid counterparty risk. So now, what is the only asset that is not simultaneously somebody else's liability and also does not have a counterparty risk? Okay, it's gold. Why do I say that? Because, okay, even Bitcoin, yeah, why people say, yeah, no, it's, you know, it's like whatever, not my keys, my coins or whatever. But please, somebody tell me how to use the thing, like without, in the absence of the internet. Like what how do I use this thing? Do I give somebody my 12 words or whatever? Like how am I supposed to redeem these things? Like you need the counterparty of this whole world, right? To even redeem your stuff. Like otherwise what do you have? Like you can maybe, you know, have a paper receipt of like whatever you had and then have that with your little 12 words and say, here you go. whenever the internet comes back on or whatever, like here, and I'm saying, okay, I'm not talking doomsday, but I'm just talking counterparty, right? Even internet companies are counterparties, right? If AT&T goes bust, yeah, if PG&E goes bust, like forget it, right? So we all rely on these counterparties, but in a deflation, there is very high counterparty risk. And when you have a very high counterparty risk, you want to hold assets that don't need a counterparty. And so that's why I said, well, gold will still go up even in a deflation. Now you may ask me, hey, come on, gold just smashed big time like yesterday and today. Why is that? Well, yes, manipulation, yes, yes, manipulation, yes, perception management. Okay, to all the folks who do go by that. But here's another very realistic thing. At the end of every calendar month, they always sell paper shorts on gold so that the bullion banks can buy physical at a discount. That's the fact. Okay, that's the American system we live in. So every month, I mean, and that's actually great market timing too. Like you want to buy something in gold, do it at the end of the month. Don't bother the whole month. At the end of the month, you go, yeah, that's when you buy stuff. Anyways, so that's why. Well, those are two reasons why. And third big reason why is when people are getting margin calls, they sell everything in order to meet those margin calls. And part of that collateral damage is also gold. So even if it was a different day, it would not surprise me. Okay, so my friend asked, well, if gold goes up, wouldn't silver go up too? Like I mean, it has to, right? The battery metal thing, the solar story, all of that. I would say that happens in an inflation when, when we are building back better, right? Then silver goes up. Yes, very, very long term, silver kind of has to go up. So, like, say suddenly gold is $2,000. Sorry, it's already $2,000. It's not $20 anymore. We're not in 1932 anymore. So, boy, it's getting hot in my car. But if suddenly gold got up to 20,000, that's a different world. That's a world where prices are different. And now, why do I say this? And this is another, it may be a long answer. Gold preserves purchasing power. Okay, gold preserves purchasing power. So what it could buy you 5,000 years ago, like they say that nice toga or whatever, same thing they say now, it can buy you a nice suit, right? The 1 ounce buys you a nice toga, buys you a nice suit. Okay, one may say I don't want to wear a toga, but who knows in another 5,000 years what people will be wearing, right? So some space suit to go to Mars or whatever, I don't know. So it always buys you the same thing. So that's a world where, so if you're saying, well, gold went up this much, that's a world where everything else is also expensive, right? Much more expensive. And that happens gradually over time. Not in that sudden deflationary, everything's collapsing. No. Then you have after all the margin calls are met, you have the safe haven, price increase of gold while everything else is done. And then ultimately, as the system sort of, I don't want to say cleanses itself, because that, anyways, but so that's my view on why gold goes up but not silver in a deflationary, with deflationary impulses. And then here's the other thing. The gold to silver ratio is really what determines the prices of other precious metals and other like rare metals anyways. So If you have a low gold to silver ratio, that is bullish for things like platinum and copper, all these other ones. Why? Because that means that gold is kind of stable. It's doing what it always does, right? It's like not deflationary, but it's like everything's fine. And then you have silver going up. That means that ratio went up, gold to silver, right? So the divisor, the numerator and the divisor. So the divisor goes up, that number goes down, right? The total number. So now if you have a lower gold to silver ratio, you have this situation where, like, stuff is happening, activity is happening, inflation even is happening. And that's the kind of scenario in which, kind of everything, everything is almost like booming, so to speak. Now, would the Fed want this? Well, okay, so I don't watch the news, like the news. So I heard something about, like, Biden got pissed off with some reporter, because the reporter asked him like a cheeky question, like, hey, is inflation good for the elections? Because it was rhetorical, because anytime, so this is the fact. If you have an inflation happening, the person, whoever is the president or leader or whatever of that country, they don't get reelected. That's just, like, Google it, how many times that happens. It's like a given. So for that reason, sure, Biden, he wants to remain president for whatever reason. God only knows why. But, and that's, whatever, that's his business. So, I mean, and I only say that because, again, like, I'm a political atheist. I have given up on the blue-red thing. I think personally it only divides people, divides friendships, etc. And I'm not playing that game. I think people vote for whoever they vote for whatever reason, like maintain hope or whatever. Yeah, Biden was a mistake. I voted for, I have to say. Anyways, I don't know how to edit this out. Okay, but you know what? We'll always be disappointed with whoever is running the place. I just say this because I'm like, the job of a president seems like a really shit job to have, because let's face it, you don't have any real power, and you kind of have to bend to the forces that the control structures, let's just say. If you want to know what that's all about, look up Francis Hunt and his 3 channels. You have to go by what the control structures want of you. Nobody's really happy with you. You can never get anything right. Anyway, so for whatever reason, he wants to get reelected. Therefore, he wants to curb inflation. He wants to curb the rising prices. So he's probably told Jerome Powell, who, by the way, when Powell joined, he was kind of hawkish, and he was, I think he was a Republican, I'm not sure. So he was like, hey, harness all your hawkness and, like, tighten. We need to get, like, I don't want to, let's get this inflation under control. And now why would I mean, yesterday's FOMC, whatever, and the press conference too, that was a bloody joke, I would say. And why would the Federal Reserve want to decimate the stock market? Not decimate the stock market. Why would they want to crash the market, say? Well, okay, first of all their people already sold and got out, right? I mean, there was plenty of insider trading last fall, let's face it. So their people got out already. They took their lifeboats and they're gone, right? Now you have all retail, meaning normal people who are stuck with their 401ks and IRAs. They're all stuck in this system, right? I mean, if you sell, get out, what happens? You get paid, you get charged tax or 50% or whatever, penalties and whatnot. Okay. So, if they crash it, first of all, they have, like, willing victims, or not willing, unwilling, like they have a captive audience, so to speak, with who they impact, right? But you could say, oh, come on, like, wouldn't people not vote for the current administration because they wrecked their stock price or whatever, or they wrecked their 401k account? No, they actually have solutions for that. Yeah, they actually do. Okay. And here's why. Okay, so just think about like the normal young person who is making, I don't know how many, like what, millions or whatever on trading dog coins and whatever. You have a young person doing that, they're not going to want to find a job. Suddenly their account goes to like negative, or like their stock values, their portfolio just crashes. They go, oh shit, I gotta go find a job. See that? That's where actually crashing a stock market helps the Federal Reserve to meet their their, well, like, what was it, not full employment, but some high employment, no, not high unemployment, some full employment type of mandate that they have. So they have dual mandate, right? They have stable prices. I say stable because what they mean by stable prices is slow theft of 2% inflation, embezzling, slowly carving out your money. Because I guess it's, if you take 2%, if you start off with a number, with a balance, and then you take out 2% every year on a steady basis. I think, what is it, in a lifespan of 70 years, you are left with half of that at the end of it. Yeah. And then you give other half of that in taxes, and then that's what your descendants get. So it's a really shit system. Anyways, so this is the 2% embezzlement that they are cool with, right? Or they've determined that we are fine with that. So that's what their stable price mandate is. Still slowly, okay? Still slowly, not too fast. Just 2%, 50% over my lifespan, or 70 years. So that's part one. But the other part is that so-called full employment, which again, because so many people, well, not only, and this is I think a more complicated one, the whole mandate situation in order to work. Like, I don't know how many people have left or lost their jobs for simply that reason. I don't know. But if you know, let me know. So yeah, but that issue notwithstanding, and which is why I think he backed off of that too and handed it off to the states to decide, which, by the way, I actually replied to that Democratic whatever. Yeah, they keep sending you emails to like beg for money. I actually replied this time, and I said, you know what? First of all, it's unconstitutional what he did, to even, like, for the government to tell the business that, oh, you need to make your employees do this. And I have no dog in the fight. Yeah, I don't work for any master, so whatever. So nobody asked me to take it or not take it. So, but this business of the government telling a business that they need to require this, that's actually what Stalin did, in Russia. Yeah. Look up this video called, I think his name, it's a man, Judge Napolitano, a man, because I understand somebody told me there's a lady by that name too. So Judge Napolitano and George Gammon, they did an interview together. And just do Judge Napolitano, George Gammon mandate. And it's many months old. So, but he actually goes through constitutional law. It was a great video. I learned so much about the U.S. Constitution that I never knew about because I didn't grow up in this country. So, I don't know how much unemployment is there for that reason. But that aspect notwithstanding, if someone is not working simply because their portfolio looks good, now suddenly that decrease will make them psychologically want to go back to work. Plus, if they have a situation where, say, their afterpay or whatever the interest rate things are all going up, again, in order to meet those increased payments, they're going to have to increase their income while looking at their portfolio going down, and suddenly they can't, sell dog coins day after day and make a few thousands here and there. That's going to push people further into the workplace. So why would they want to crash the market? It would help them meet their dual mandate thing. Now the two caveats I had, like how would you solve, quote unquote, solve a deflationary depression type of a situation? Well, you would solve it by CBDCs, central banking digital currencies, because those are completely programmable. You can do full behavioral economics control of a person, because suddenly they can't just exit the system if you impose a negative interest rate. If you say, oh yeah, here's your paycheck, you can hoard it, right? You can hold on to your cash. You can remove your cash from the bank. If they have a negative interest rate, you can remove your cash and say, fine, I'm not spending it. I'll spend little by little as I want to. But if you change that to central banking digital currency, you don't have that option, because now it's a digits on a screen, and if there's an expiry date that, if you don't spend your entire paycheck or stimmy check or whatever check by this date, it expires. Oh my God. Like, just think about how much inflation, how much rising prices, and how much velocity that would increase, because you suddenly, like, you don't want to increasing prices, kind of that velocity thing. Think about it like a hot potato. You don't want to have those digits on your screen because they're going to expire anyways. Think of it like a coupon with an expiry date. You got to use it before it expires. So that CBDC, central banking digital currency, is how they can mobilize, like, people out of a depression where the velocity of money has slowed down seriously. And the other reason, which is really dark, is by having a war, by going to war. That's how. Because as soon as once you put in that sort of thing, it becomes existential. You do employ all the young men. Check out my book review, Dr. Warren Farrell's The Boy Crisis, and how boys are kind of, it's sad. Like the way, yeah. I don't want to see the war option, frankly. But all the saber rattling that's going on right now, all this bullshit, really. Also, made up hacks, made up attacks, made up things that, that will disrupt supply chains, that will then again freak people out and get them to buy more things and spend money quickly and hoard up and all that. Those are all, or just even genuine supply chain things that would increase prices to kind of, but then again, Biden doesn't want an environment of increasing prices. So I think I think at some point he would impose price controls, like rations, that kind of thing, central banking digital currencies, and do some war saber rattling. And I know my ideas never end on a very happy note whenever I start thinking about the next few years, but whatever. And if my friend watches this video, this is why I guess I don't make videos about such things. But I just respond over text because, it always goes dark. Anyways, if you're still here listening to this, thank you for listening. I appreciate your time. And let me know what you think. If you have any other questions that you'd like me to answer or talk about, let me know. And on that happy note, I bid you farewell. Bye.